Welcome to our monthly portfolio update. I'm Elvis Picardo, Senior Portfolio Manager with Luft Financial IA Private Wealth. The global rally continued for the fifth month in September, with the markets seeming to reach new highs every other day. Canada's TSX rose 5% last month for a Q3 gain of 11.8%, its best quarter since the pandemic 5 years ago. The index is now up 23% this year, on course for its best yearly performance since the recovery from the great financial crisis in 2009. Broadly speaking, the markets are being driven by a bullish combination: expectations for continued robust earnings growth, a resumption of interest rate cuts, and ongoing enthusiasm for artificial intelligence or AI. But that's the glass half full part of the argument. Here's the glass half empty part. It's that earnings growth may slow down as tariffs begin to impact the global economy. Interest rate cuts may foreshadow an economic slowdown or could be delayed if inflation proves to be stubborn. And finally, the hundreds of billions being spent on AI may represent a bubble similar to the dot-com one 25 years ago. Due to investors' complacency in the face of growing risks, as we have pointed out previously, many market watchers have been braced for a correction in recent months. We are now beginning to see a little bit of nervousness in the markets. But it's nearly impossible to time the top of the markets or the bottom for that matter. What we can do is take specific steps to mitigate the downside risk that is inevitable at some time. So here's what we've been doing in your portfolios. In keeping with the market axiom that you never go broke taking profits, we have been booking gains in profitable positions like the Platinum Growth Fund, which is up 13% this year. We have allocated those proceeds to fixed income alternatives like the Dynamic Short-Term Credit Plus ETF and the Picton Long Short Income Alternative ETF, thereby boosting the yield on a fixed income portfolio and helping offset bond market volatility. We made these changes through a rebalance on September 24th that brought asset allocation in our portfolios back to the target weights. Now, I want to leave you with two specific action steps. First, because equities are close to their all-time highs, this really is the best possible time to re-evaluate your risk tolerance. If you are apprehensive about a potential market pullback, speak to one of our advisors and they can help you decide if you need to go a notch lower on the risk scale. And second, if you have money in a high interest savings account or HISA, I recommend that you switch to our defensive high quality fixed income portfolio. You'll get a significantly higher yield and also some capital appreciation if interest rates and bond yields decline as we expect. You should expect some volatility if you make the switch, but the trade-off is worth it. So please check out our website for more information on our portfolios and strategies, and thank you very much for watching. Until next time.